Good morning, ladies and gentlemen. It's our pleasure to welcome you to Photon Energy Group's investors call in relation to the publication of our second quarter and first half results publication. Next to me is Clemens Wormuth, our
Morning.
CFO, and my name is Georg Hoth. I'm the CEO of Photon Energy. We've had a very successful second quarter and first half, and together with Clemens, we'll walk you through the details. We will start again with a very brief introduction of our business model, as we're hoping that today we are welcoming also some new guests to our call. So just to give an update, we'll then walk you through our strategy and outlook, and then Clemens will present to you in detail the financials, both for the second quarter and the first half. And at the end, there will be room for questions that we will try to answer as best as possible.
Maybe you can add already, if you want to have questions in between, just put them in the chat box and we will answer them then at the end.
Yes, so as they come, please send them over. So just very quickly, Photon Energy, we've been in the business for soon 15 years, and we are a Dutch company headquartered in Amsterdam. As an organization, we continuously grow, so we have now exceeded 170 employees globally. We are active in over 10 countries. Obviously, we're a public company, and our shares are traded on the regulated markets in Warsaw and Prague, and also on the open market in Frankfurt. Last year, we obtained a sustainability rating from EMUG, so we are an ESG compliant company. We have now also in the first half of this year seen 3 research houses take up research coverage of our stock, and all 3 of them have initiated the coverage with a buy rating, and based on the results today, also 2 of them have increased their target prices. We have 2 main business lines. One of them is solar energy, which of course in terms of contribution to revenues, but also the weight within our balance sheet is the dominant one. But we have a second business line, which is water, which operates through our brand Photon Water, and we'll also go into detail on that one. So the key headline numbers for our solar business line is that our PV project pipeline across the CE region and Australia has again grown a little bit to 825 megawatt peak. We have to date built over 120 megawatts of power plants, the vast majority of which and specifically 91.9 megawatt for our own proprietary portfolio. Last year, our portfolio produced 103 gigawatt hours. Only today, we also published our monthly report for July. So for the first 7 months of this year, we generated 80.5 gigawatt hours, which means that we are well on track to exceed that level of last year quite significantly. And of course, with the additions of new power plants in the coming years, this number should continue growing dynamically. And in our operations and maintenance business line, we take care of over 325 megawatts of power plants. These are, of course, our own power plants, but also those of external customers, and that external customer base we expect to continue growing in the next quarters. In the water business line, we have several areas of focus. One of them is that we take care of surface water bodies, which are lakes and ponds, where we're taking care of over 600 hectares. We work with mainly water utilities in managing the water wells, and then a very exciting area is groundwater remediation for various contaminants, but the one where we see significant global potential is in the area of treating groundwater that is contaminated with PFAS, or some also call them the forever chemicals. More on that later. On our business model in our solar division is that we are fully downstream integrated. Upstream in the solar industry is the manufacturing of the various components, modules, inverters, mounting structures. So there we're not involved. There we're customers, but everything after that and everything in relation to the development and the entire life cycle. Looked at it financially, you could talk about the value chain of a PV project that later becomes a power plant. We cover through starting with project development, where we develop in the markets where we operate in-house, or we enter into co-development arrangements with other developers, and in some situations we also buy projects that have been brought to the ready-to-build stage by external developers. And then we procure, we design the power plants, we procure the technology, we build the power plants, but most importantly, we also own those power plants, where our investment horizon is essentially forever. And we, unlike some of our peers, we do not buy existing assets from other developers operating plants, but we also don't sell our plants. The only exception to that is a market exit, which we had some 10 years ago when we left the Italian and the German markets. But essentially, we built power plants for our portfolio to hold them forever. Connecting a power plant is, however, only the first, very important, but first step in a very long journey, as the technical life of PV power plants is 30 years, and with the improvement in PV technologies, probably longer. And when you look at the potential to repower power plants once certain components reach the technical life, also beyond that, and we see that in the industry, more and more investors and also lenders start treating power plants as 50 assets. So these and in today's environment, and we'll talk about our merchant strategy later on. The beauty of a PV plant is that it is an investment that, well, an asset that requires a significant upfront investment. However, the fuel is for free, which is a major competitive advantage to many other energy forms. And secondly, the cash operating costs are very, very small. So by definition, the EBITDA margins are very high. And with a merchant approach that we've adopted, and so where we're selling into the market, we believe that PV power plants, based on the advantages I mentioned before, are a great inflation hedge. So in our water services division, we focus on water treatment and managing water wells and resources. Our main target group there are water utilities, so that is a business where we continue adding new customers. It's water resource management focused on surface water bodies, and here we have a particular focus on fighting blue-green algae bloom, which has become actually worldwide a major problem, contaminating both water bodies used for recreational purposes, but at the same time also contaminating drinking water resources. And the last area, which for us is very attractive and where we see very significant potential, is our patent pending nanoremediation technology, which we have been applying over the last couple of years to sites with various contaminants. But the really promising and significant area is that our technology seems to also be effective in breaking down PFAS chemicals, which, as I mentioned before, are very often referred to as forever chemicals. This is a group of chemicals that is used in Many products that we're using today because of their water and oil resistant properties. So we find them in textiles like Gore-Tex, we find them in food contact paper, but they've also been added to firefighting foam. So because of the fire retardant properties. So this is a group of chemicals where the contamination is very significant, particularly in the industrialized world. Australia is one of the or is the market or the country that has been first and is at the forefront of regulating the contamination of PFAS strongly, continuously reducing the permitted limits. And we have an ongoing project with the Australian Department of Defence on which we believe we'll be able to report results and progress in the next couple of months. Our presence is focused on two areas. One is Central and Eastern Europe, with our core markets being the Czech Republic and Slovakia, where we started our business, and then Hungary, Poland, and Romania. And the second market is Australia. However, we do not limit ourselves only to these areas. We are constantly open to reviewing market opportunities elsewhere, be that adding another aviation market to the 5 core markets in Central Eastern Europe, and we do look at opportunities there, but also outside these areas and even outside Europe. So as mentioned before, our project pipeline at the moment is over 800 megawatts, focused on Australia, Hungary, Poland, and Romania at this point. Our power plant portfolio is the largest chunks, over 50% of our portfolios at the moment in Hungary. As we have announced, we plan to connect 32 megawatts in Romania by the end of this year for our own portfolio. So that composition will change, and we are also hopeful that next year we will be adding our first assets in Poland. So moving on to our strategy and outlook, the big one and the driver for our results at the moment is, of course, electricity generation. So the fuel for our business model is ready-to-build projects, and there it is, from our point of view, very important to have full control. So not to be one out of many investors at the moment who are chasing anything that looks like a buildable project, but we have built up and we continue building up our capacity to develop projects in our core markets from scratch, or to be a strong partner for a junior developer to bring projects to the ready-to-build stage and then take them over for realization. And as we have all the engineering capabilities in-house, we are the equity investor, and we know how to secure financing for this project. We are also a very attractive and straightforward partner for such junior developers. So having control of a pipeline while still being in the market and looking for acquisition opportunities, which are emerging at times, is a key element of our business model and our strategy. What we will be focusing more in the future is also providing EPC services, so engineering, procurement, and construction to external customers, which has not been the main driver for our growth strategy. However, given the significant demand, and not only from the utility scale sector, but in particular now from the behind the meter sectors, on-site generation, we are building up capacities to address this market opportunity, which I would say at this point is definitely Europe-wide, if not global, given where energy prices have developed over the last year. Another very important element of our strategy is operations and maintenance. While in our consolidated results, operations and maintenance represents a relatively small share, it is, first of all, from our point of view, very important to be able to effectively operate our own power plants. But operational maintenance is a very interesting business in its own right, as it provides recurring revenue streams from a diversified customer base. And it is not too dissimilar to facility management in real estate. So clearly, the numbers are much bigger when you develop or build an office building than in the facility management afterwards. But on the other hand, when you look at transactions, when facility management companies get sold, they get sold on high multiples because it's a very stable business. And we do see we're positioning ourselves, particularly in the CE region, as a local player who, however, has not only long-term experience, but also has the spirit of taking care of power plants properly, as we ourselves are owners, so we understand how the owner of a power plant thinks. And we see that this approach is getting picked up and getting traction, not only with domestic investors in each of the markets in the region, but that we're also an increasingly interesting partner for financial investors from outside the region that are buying or building assets across Central and Eastern Europe. This gets us to another very important element, particularly these days, is our technology business line, which essentially serves two purposes. One is the procurement of components for the construction of our own power plants, and also for the APC activities for external customers. But particularly when we look at the contribution in the second quarter, and as we believe also for the rest of the year, the distribution of mainly modules, inverters, and now very dynamically growing also batteries, where we buy from the major manufacturers worldwide, which these days tend to be in China, and we distribute those to installation companies, but also smaller and medium-sized EPCs, and in some cases also into specific projects where we're selling them to the developers. And particularly given the supply chain disruptions, but also and logistic issues, having direct access to manufacturers, having a flow of product coming to our markets is very important. And in our 15-year experience in the solar industry, that always tends to be an issue. So we have seen shortages of modules, we've seen shortages of inverters, we've seen issues with the logistics, and at the moment, several of these issues are coming together. So being able to access these products efficiently, having some of them in stock, is a major strategic advantage at this point in time. So it's not only about being able to buy on better terms, but maybe having the product at all. And when we look at batteries, our decision and bet on importing significant volumes this year is paying off very, very well, as there's a major shortage across Europe at this point. And last but not least, water is extremely important, where I would say that in terms of global potential, clearly, if we prove that our remediation technology is capable of breaking down PFAS chemicals in situ, that means underground, without having to excavate ground or pump the water for further treatment, the market opportunity is global and extremely significant. And what we see is that in Australia, regulation is becoming ever more strict. It is becoming a massive topic in North America, and we also see finally Europe waking up to this issue, and both at the level of individual countries, but also at the EU level. And we believe that there will be the regulation will become stricter and stricter, and the opportunities will be very, very significant over the next couple of years. Coming back to what is driving our revenues and profitability at this point in time, is definitely the growth in energy prices, to which we believe to have reacted correctly at the right time. Our first fully merchant project were the two projects in Leiden that we commissioned in August last year. So there, from the very beginning, our strategy was to not sign any long-term power purchase agreements, but to sell into the spot market. For this year, we swapped the support scheme for our Czech portfolio from a feed-in tariff to the so-called green bonus system, which means we still get the subsidy element based on the fact that these are vintage 2009 and 10 power plants, but we maintain ownership of the electricity, which we are selling in the day-ahead market. And we also reacted as quickly as we could to changes in Hungary that have allowed us to exit temporarily, given the price curve that may actually be a long-term situation, but to temporarily exit from the card support scheme for the vast majority of our Hungarian portfolio. So instead of a feed-in tariff that at the moment, given the exchange rate, is below 90 euros, we are realizing the current market prices, which are actually a significant multiple of those 89 euros. And as you can see from the graph, since the beginning of the year, the price curve has moved up dramatically, particularly on the short end. By that I mean the next 2 years. Yesterday again, all the futures in Leipzig went up quite significantly, and so in the markets where we have assets at the moment, the base load price for next year, for the full next year, is around 450 euros and above, and peak load over 600 euros. So if you take against that our levelized cost of energy, which is that blue line, which depending on market is somewhere in the region of 60 euros. Maybe if interest rates go up again, if on the euro, we've seen now a slight reduction in the last couple of days. I believe if it moves to 65 or 70 for whatever reason, we are still dramatically below the market prices. And this levelized cost of energy already reflects our cost of capital and spreads the investment cost over the expected lifetime of those power plants. So this is where I would get back to my comment about the PV plants being a very attractive hedge against inflation. And so even if energy prices come down, and of course, when we see the potentially devastating impact on the wider economy, we probably a reduction is warranted and needed. We will still be able to generate returns well above our cost of capital. So come back to project development. So as you can see, we in Romania, we have now in the last couple of weeks moved several projects have moved from advanced development to RTB and under construction. This is in line with what I said before and what we've announced, that we want to connect 32 megawatts by the end of this year in Romania. And of course, that pipeline in Romania will continue maturing, and projects will be moving across the stages. In Poland, where we are developing projects from scratch, and in Poland this is a relatively long process. You can see that our funnel continues growing. So there we really go out, we look for suitable locations and go through the entire permitting process. We will see maybe going forward, we will be able to identify some acquisition opportunities to accelerate our rollout. But what is important for us is to actually own the right assets, and that in our case means power plants that are built on single axis trackers. And what we see is other developers in Poland are developing fixed projects, which we don't find that attractive, particularly as our goal is to sell electricity in the market. And with trackers, we are able to produce more electricity in the morning and the evening when prices are higher than midday. In Hungary, we continue developing our approximately 26 megawatts in one of the regions in Hungary, in the south of Hungary. And given that the way PV projects will be developed in Hungary has changed, particularly in relation to how grid connection can be obtained, we are now at the beginning of starting a new wave of development. So while this pipeline at the moment is relatively small, we continue believing in the Hungarian market and the opportunities available there. And in Australia, we are currently we continue developing our first project based on the Radiant technology, a 300 megawatt project in Yanari in South Australia, where basically the project development is ongoing as planned, and we expect ready to build by the end of next year. This is a very, very significant project in size, and not only in terms of generation capacity, but with a planned 3.6 gigawatt hours of storage capacity. It would actually at this point be the largest energy storage project in the world outside pumped hydro. Just a quick update, or rather an overview. So we invested in Radiant for the first time in April 2020, followed by a second round in April 2021, where AGL, one of the leading utilities in Australia, co-invested along also Schlumberger and Chevron and Equinor. So the reason why this technology is interesting is Radiant has managed to combine PV and concentrated solar. So you've probably seen concentrated solar pictures of concentrated solar plants before. So essentially, a mirror field reflects sunlight into a focal point where the heat gets collected, and traditionally that heat gets then transferred into a medium such as oil or in some cases also salt, which then melts. So basically the thermal energy gets stored. What Radiant managed to develop is a PV cell that can be placed in that focal point that can withstand the high temperatures of about 700 degrees Celsius, so that this concentrated sunlight gets used twice. First to instantly produce electricity through the PV cells, while the heat still gets captured. And the second part is also an innovative approach to energy storage, where the storage medium is water. So there are two hyper-insulated water reservoirs that are built, one for the hot water, which is kept just below the boiling point. The electricity generated from the PV cells is either fully or partially used to chill water in the second tank, just below the freezing point. And then when electricity is needed through a organic Rankine cycle engine, which is a low pressure gas turbine, electricity is produced on demand. And this system can run as an island, that means not connected to the grid, and service, for example, a remote mine or a remote community. But it can, of course, also be run in a grid connected setting, and beyond just electricity, it can also provide grid support services. The main advantage of the system is that the production profile, and this is one of the major disadvantages of solar on its own, that it's intermittent. Solar is an intermittent source, and electricity is produced when the sun shines. Here, it's possible to completely decouple the production profile from the supply profile from the production profile. So even if you add batteries today to a PV system, economically, it only makes sense if you shift the supply to the grid by a few hours, or you stabilize the production, the supply profile. But with the radiant system, if it's properly designed, economically, you can completely transform the supply profile. That means we could turn the solar generated electricity into a 24-hour base load. We could supply only at night, and we see that in many countries today that where a lot of solar has been built, when the sun sets, the diesel generators still need to be switched on. So radiant, that's exactly where radiant could come in and replace that dirty generation capacity when PV is not operating. As one of the investors and also development partners, we are alongside AGL, which is actually planning to build a 150 to 200 megawatt radiant power plant in the location of a coal-fired power plant in Liddell, New South Wales, which is slated for retirement in the next 2 years. We are one of the few in the world that have access to this technology, and we've decided to, from now on, develop all our large-scale projects in Australia based on the radiant technology. So Yadnarie is the first step. We're of course looking for other locations, but we're also looking at opportunities in other parts of the world. So we believe that there will be progress to be reported in the next couple of months and quarters. So on one hand, we believe that our investment region will be a very good financial investment in its own right, but it is a door opener for us, and it puts us at the forefront of a very viable solution in many parts of the world, how to address the energy supply issue. So to conclude, with respect to our outlook, we together with the publication of our Q2 results, we also updated our guidance for this year, where we've lifted our projection for consolidated revenues from 65 to 85 million euros, which would mean that we would more than double the number from 2021. And we've also lifted our forecast for our consolidated EBITDA, which last year stood at 9.6 million. Our previous guidance was 18 million, and we have lifted that now to 24 million euros. At this point, it's of course very difficult to see where the market goes in terms of electricity prices. They keep going up, but this is a number that we are very confident in being able to achieve. We also have a set of targets we communicated in relation to full year 2024. So one is that we want to grow our proprietary portfolio to at least 600 megawatt peak by 2024. The build out this year will represent a step towards the direction, but of course it also foresees a lot of construction activity in the next 2 years. As you can see, our pipeline with 825 megawatts which continues growing, is helping in this. So of course, a lot of focus now is in executing that growth. What is important here is the improvement in our financials year to date, and also for the rest of the year, is of course to a very large degree driven by higher energy prices. But as our portfolio grows, the marginal impact will of course come also from megawatts, so additional megawatts. And what you can see now in our financials kicking in is operating leverage. So we have built up a lot of capacity over the last couple of years, both in terms of human resources, but also, of course, the project development pipeline. I mean, for example, our pipeline in Romania, we started developing 4 years ago at a time when nobody wanted to look at Romania. So certain things need time to mature. And in terms of transforming that pipeline into power plants, the time is coming now, of course, at a time when PV plants, energy prices are very high. But the important thing is that as we add megawatts, and even if energy prices go down somewhat, with every additional megawatt that we add, as I mentioned before, each PV plants have EBITDA margins of 90% plus. Our cost base is not going to grow anywhere near that number. So as we add megawatts to our portfolio, this will feed relatively straight through our P&L and continue driving our profitability. And with the 600 megawatt target in mind, that effect should be very, very significant. Our goal is also by the year of 2024 to at that time have a project pipeline of 1.5 gigawatts under development. For our O&M division, our goal by year in 2024 is 1 gigawatt, which is a combination of our then significantly increased proprietary portfolio, but also external business. So this is also a number we are very comfortable with. And we've also put out a target for our EBITDA. We said it would grow 5 times over the 2020 number, which is 42 million, which even 6 months ago looked like a very bold statement. I guess now with our guidance, we are really closing quite a significant part of that gap this year. And as I said, with more megawatts coming online, this is definitely an achievable target. And I think it's important to note when we put out this 42 million target, in mid-2021, energy prices were at the 60 euros they used to be. So we are very confident with that target. And at the same time, of course, we want to and also need to maintain our equity ratio of 25%, which is also covered in our bonds that we have placed in the market. So we want to maintain a sound balance sheet in our industry. High leverage ratios are common. So, but we definitely don't want to overdo it, and we're trying to stay comfortably above the 25%, but not too high above 30. So basically around the 30% mark. And as Clemens will walk you through the financials, you'll see that's where we are essentially at the moment. So with this, I'm handing over to Clemens to walk you through the financials in greater detail.
Thank you, George. Once again, good morning from my side. I will walk you through our financials now for the second quarter and the first half year of 2022. I'm very happy to do so because those numbers are record numbers that we have presented and that I want to give you a little more detail on. Before we go into the numbers, just to wrap up the recent highlights, and I think George has mentioned a few of those already. Biggest impact on the numbers is clearly that we harvest the high electricity prices that coming from switching to the green bonus scheme in the Czech Republic, as was said already. And since 1st of April, we also have changed the majority of our Hungarian portfolio to temporarily, partly permanently exiting the feed-in tariffs and harvesting high electricity prices. On top of that, we have added in May 1 power plant in Hungary to bring our total installed capacity to almost 92 megawatts now. We have started construction in Romania in the second quarter as well, in June actually, and some preparation works already before that. That at the moment we have 5 power plants on the way with 16.5 megawatts. The total goal for this year is 32 megawatts to still connect in Romania bringing our total capacity to more than 120 megawatts. We have tapped up our bond, our green bond that we have issued last year. As you know, we have tapped it up by 10 million from 55 to 65 million now, so giving us more financial power to also accelerate our future growth. And what we are very proud of is that we have been covered by 3 research houses in Germany, by Ulster Research, in the Czech Republic by Wood & Company, and by Ipopema in Poland. All of them have issued buy recommendations for our shares with price targets clearly above the current trading prices. 2 of them have now, based on our half-year figures, already revised them, the price target upwards. So we are quite happy about this development. The key performance indicators which drive our financial numbers, as mentioned, we have 92 megawatts installed capacity. Out of that, and that you can see on the graph on the right side, almost 83% are now merchant exposed. So basically, we can harvest the high electricity prices. 16.2, which is mainly the Slovak portfolio, and a few power plants in Hungary still remain under a feed-in tariff scheme, as we had it before. We have generated just in Q2 almost 40 gigawatt hours. George mentioned already the July number. Here you can see still the June number with 66 gigawatt hours for the first half year. You can see here is the proportion of merchant gigawatt hours, which are translating in the higher electricity prices, a little lower than the megawatts. So then this 83%, that is due to the fact that the Hungarian portfolio was switched only in April. So the first quarter was still under feed-in tariff. But going forward, that proportion will even increase, and we are keen to see then this kicking into our financials even more in the Q3 and Q4 coming ahead. On the bottom right side, you can see this market exposure a little more clear in numbers from the portfolio, what has switched, and also the actually realized average revenues. So in the Czech Republic, with the green bonus, this combination of feed-in of a support mechanism and merchant model, we even could realize some 760 euros per megawatt hour. In Hungary, the average for the whole 6 months was 197 euros on the merchant part, compared to some 96 euros on average on the feed-in tariff. So we more than doubled the revenues there for the same, kilowatt hour or megawatt hour produced. In Australia, prices have increased in Q2 as well, quite a bit, and we can see this trend there as well now coming, even though it's from Europe relatively independent market, with 113 euros as a comparison. So we are very happy about this development, and that actually kicks in directly in our financials, where we have realized in Q2 only a revenue of 23.2 million, a growth of more than doubled, 135% from 9.9 million in Q2 last year. Year to date, with 32.4 million in revenues from 14.4 million, also more than doubling our revenues, and almost after only 6 months, we have the same revenues as last year for the full year, where we had 36.4 million in revenues. Still, majority of those revenues is electricity generation, which also delivers the highest profit margin, the highest EBITDA margin. We had in Q2 11 million generation or from electricity generation revenues, compared to 6.9 million in Q2 a year ago. So a 60% increase almost. Year to date, we are ending with 15.9 million in the first 6 months only, and we also published this now in our July report. The expected revenue from electricity generation in July alone will be more than 5.5 million in addition to that. So we are very well on the way to achieve our guidance there. Other revenues were mainly driven by technology sales, where we can see also a sheer almost endless demand for components. Mainly the battery business is skyrocketing there, but also our traditional sales of modules and inverters is showing very strong demand, which also had which is reflected in our financials here in the revenues. And by basically shifting more and more into the battery business, or adding more and more battery business, which has higher margins, we also can see that the margin in the technology trading business is going up. That leads to, and this is what you can see here very clearly, the kick in of this kind of economies of scale George mentioned before. We can see now that our EBITDA more than doubled in Q2 to 8.1 million from 3.9 million last year, and for the half year to 10.1 million after 4.1 million a year ago. Here is also to mention that that EBITDA is after a windfall tax that has been, we are affected also by windfall taxes, potentially at the moment in Hungary that has been introduced there. We are affected very little to that, only very few power plants, about 10 megawatts that we have installed in Hungary are exposed to a windfall tax there, where we basically have to pay the difference of the realized merchant prices to the feed-in tariff that was there on those power plants. For this, we have to pay a 65% tax, so we just get 35% of that markup. Nevertheless, and this kind of windfall taxes is not considered in IFRS reporting, as you can see here, as a tax, but as a operating cost. So it's reducing EBITDA that is already incorporated there. We have this exposure in Q2 and going forward. We also have reflected that clearly in our guidance. So we count on that happening. In other markets, we are not exposed yet to any windfall taxes. So this is what you can then also see in our numbers. The positive record EBITDA goes down actually to, and this is I think what makes us very proud, that to the net profit after tax that turned into the black positive with 2.03 million in Q2, and also year to date with 539,000 euros. We are very happy about this development. I mean, very often we have been asking these calls also in the past, when are you going to be profitable? So now we can happily announce we are profitable, and we clearly intend with our outlook to stay there in the black numbers. Going to the very bottom line that then goes into equity, total comprehensive income that decreased a little to from the great result by a negative other comprehensive income. Still, we are above last year's numbers, even though we have connected our power plant and reevaluated the power plant in Hungary, in Tolna. There was a negative effect from foreign currency translation differences, mainly driven by the Hungarian forint that was and is weakening compared to the euro. But still, this positive total comprehensive income is then reflected in our equity, which brings me to the balance sheet, where we could grow our equity to 53.9 million from 51.5 million year-end last year, so a growth of 4.7, bringing our equity ratio, especially the adjusted equity ratio, which is important measure for us, or KPI, in terms of our bond investors, to 29.3 from 28.8%, so a sound equity ratio. On the Activa side, the balance sheet sum basically remained stable, grew a little to 202.3 million. There is a slight decrease in the fixed assets that is coming as well from the Hungarian forint weakening, which was overcompensating the addition of new power plants in Hungary on the one side, plus all the development that is already visible in the balance sheet as well from Romania and from the other markets we are active in. Our other current assets increased as well a bit to quite a bit, from 14.8 million to 2.1 million. That is mainly a growing trade receivables and other receivables. Trade receivables is in line with the growing revenues, mainly coming from also switching the Czech portfolio to the green bonus scheme, where basically we get a significant part, 25%, only paid out quarterly instead of monthly. So that is something which is adding up then, and other receivables as well have grown there. On the passive side, I mentioned already, or we covered the equity. On the debt side, we have increased our non-current liabilities. This was mainly the bond placement, where we placed another 10 million euros, increased debt. On the other side, we had some regular repayments and some early repayment on our portfolio in Hungary. That was then reducing those liabilities as well, again, bringing the number to 115.2 million. Coming to the cash flow, we had in Q2 alone relatively balanced operating cash flow. So even though we have a significant growth in EBITDA and operating performance, the working capital effect is very negative in terms of that we have prepared a lot, and by increasing the accounts receivables, we have reduced compared to the previous periods accounts payables, which has a negative effect on the working capital. We also have increased our stock inventories, which is then reflected there. All these are measures which are in line or which are necessary for our business growth, to secure procurement of components for the technology business, to secure procurement for our own power plants that we are building right now in Romania. So all that is a necessity, leading to a operating cash flow for the first half year of -7 million or -6.7 million, sorry, on that side. But this effect will be also balancing out over the time. On the other side, our investment cash flow has been in Q3 now with -3.4 million overall for the first half year, -4.3 million compared to 7.7 million last year. So it's a little less than there yet. Again, here, this will be changing as well going forward with the significant construction we have started in Romania already, and going forward, what we intend to still build and connect this year in Romania. The financial cash flow is with -1 million, slightly negative, coming from a positive effect of 10 million from the funding from the placement of the green bond, compensated by the repayments, as I mentioned already before, and by the interest payments that we had mainly. So this is the quick view on the financials. And I think now we can go over to the Q&A session. Maybe we start.
Well, actually, maybe because I saw the last question related to working capital. So maybe let's start with that. So
maybe I should.
Well, I would maybe, because when we expect it to stabilize. I mean, first of all, I think it's important to stress that as we operate along the value chain, I mean, for the solar segment, when you look at the various business units that are involved in this whole process of development, all the way to connected power plants, except for development, all the other business units, so that's engineering, that's technology, it's operation maintenance. So they serve an internal purpose, but they also serve external customers. But when you look at these businesses, then the economics are very different. So O&M, as I mentioned before, is essentially like facility management technology, buys and sells. So stock levels are an issue, but it's also the procurement arm for our investment activities. So the effect, and so of course our idea is the goal is to use our capital efficiently, and allocate to those activities that bring most value. So I think that the key drivers in the first half of the year that led to this is, first of all, the 32 megawatts we're currently building in Romania, of course, have a significant lead time, and lead times for certain components have gone up. So that would be, for example, transformers. We have seen now things have stabilized a little bit, but at the beginning of the year, we saw that both lead times, but also prices for example, mounting structures were going up very dramatically. And for us, it was very important to make sure that we can build those power plants where the projects are ready to build before the end of this year. So in relation to Romania, a lot of so particularly transformers and mounting structures, which together are several millions of euros, were procured in the first half of the year, even because we managed to get them at good prices, particularly the mounting structure still at prices, material prices reflecting levels before they jumped up dramatically. So we decided to order them, lock them in, even at the price of having to store them for a while. Of course, we also procured the other components like the modules, inverters, where we made down payments. So capital was allocated to make sure that we will have all components in place to construct the power plant, the 32 megawatts in Hungary, in Romania, which of course is a major priority. So there we essentially parked several millions of euros in what is now inventory, which of course leads to a negative operating cash flow. The second effect is clearly linked to the external business in technology, and again, what is growing very dramatically. And here I would also maybe link to another question, which was about the visibility of our trading business in the second half of the year. I mean, a key driver of the growth, but also the profitability of our trading, are batteries. And there we have basically secured through a cooperation with a major manufacturer in China, significant product flows, which are now peaking in the second half of the year. And again, in relation to that, where down payments need to be made. So that is also now in Q2, to some extent also in Q3, that is eating into working capital. But you can trust us that it's worthwhile. The margins are attractive, and it's a good allocation of capital to secure that flow. And we're basically, the batteries that are coming in and that we expect to have contracted until the end of the year. The demand is literally endless, and they are already pre-booked by our customers several months in advance. So that is eating into working capital. And the third effect, which is also fully hit us actually in the second quarter in particular, is related to our generation revenues, which have gone up on a monthly basis, now hitting a new record in July. Of course, when we take the June revenues of 4 million, they were generated in June. We have earned those revenues, but of course we get paid only 3 or 4 weeks later. So it is also in receivables. So several factors have come together that led to this. So it's not necessarily, it's in no way, from our point of view at least, a negative sign. It is just so we clearly allocate and work with our capital as efficiently as we can, and so there is no, but because it is driven by several partially related, partially unrelated activities, it's not like we're targeting the operating cash flow in a given quarter to be a certain number. It's about capital allocation. Sometimes it's an investment, but sometimes it's a pre-step to investment, like securing components for power plants that will be built 1 or 2 quarters later. And of course, a growing distribution business takes in working capital as it grows. So I hope we've been able to answer that. Those two questions in one go. So let's maybe move to the first question, which is new investments in the Czech Republic and Slovakia. Well, both these markets have, in terms of project development, not been at the center of our attention, and I'm talking utility scale projects, as our focus has been on Hungary, Romania, and Poland. From our point of view, these two, the Czech and the Slovak markets, the Czech market has woken up a year ago. Slovakia still has a lot of issues related to grid capacity. And it is, of course, a very small market where, how to put it nicely, incumbent players have or more local players than us have a strategic advantage in securing the little bit of capacity that is made available. So we're keeping an open mind. However, and that also applies to the Czech Republic, any project in the Czech Republic in our capital allocation into new capacity is competing with opportunities in Hungary, in Romania, Poland, and elsewhere. And what we found is that in the Czech Republic, in particular, land that is offered to us, or projects, including the land, are very expensive. So while in Romania we can buy a square meter for 2 euros, people in the Czech Republic offering projects 120 or 30. And the electricity price is essentially the same. Production is 15 to 20% higher in Romania, and the land costs 10%. So in internal competition for allocation of capital, typically Romanian and Hungarian projects have an advantage over Czech projects, which does not mean that we're not interested, but it is probably not such a priority as growing our portfolio in these other countries. I would assume 3 years from now, our portfolio will have some new power plants in the Czech Republic and Slovakia potentially, but it is definitely not at the center of our strategy. The situation is different in behind the meter, where we also expect to allocate capital and build power plants where we sell electricity based on power purchase agreements to the behind the meter off-takers. And there, of course, the Czech and Slovak markets, Czech at the moment more than the Slovak, will play a role alongside opportunities we're pursuing in Poland, Hungary, and Romania, and potentially other markets as well. So there will be more activity in the Czech and Slovak markets behind the meter than the utility scale. However, it will not be a driving factor.
Good. I think the next question is about windfall taxes. I think we went into that, where we are exposed in Hungary. As said, this is reflected in our EBITDA and also in our guidance already.
Yeah, I would add that this windfall tax is mainly aimed at projects that have been receiving support in the past and exited those support schemes, which of course we did. However, it does not apply to the vast majority of our portfolio. So the differentiator here was it applies to power plants that have a generation license, which is necessary above 500 kilowatts of grid capacity. And most of our projects in Hungary are just below, so they're unlicensed, so they're not affected by this. But also going forward, the important thing is that this tax, and of course things can change, but the moment that the tax is applied at the moment, it does not affect merchant projects. So when we now add another megawatt or let's say the 25 megawatts we have under development and sell into the market, and these projects have never been receiving support, they're not subject to it. Yeah, so that is the situation at the moment.
Next question about
situation with component material costs
and inflation or increasing component costs. Maybe George,
well,
add to that.
As I mentioned before, well, on the module and inverter side, the cost increases have been modest. So actually, the biggest driver with respect to these components has been the weakening euro towards the dollar and also against the yuan. But on top of that, logistics costs. So the disruptions in logistics, of course, a lot of it also linked to the COVID lockdowns in China, So any increase in prices, so the prices of modules and inverters, FOB China, are not changing much, and if they've changed, that's driven by the exchange rate movements. But we're talking about a small number of, a few percentage points. The logistic costs are having an impact clearly, but that has already been the case a year ago. And so the other factors were mainly raw material costs, whatever goes into mounting structures. So there has been an increase, but that has also now come to a stop. So, but given where energy prices have gone, if modules or even the total power plant, if investment costs go up 10%, if the electricity we're selling for 3 times as much than we did a year ago, it almost doesn't matter. So the way we look at it is mainly, and here I come back to what I said about this procurement of key components for Romania already at the beginning of the year is actually component availability. So if anything, if we are concerned about anything, it's not so much whether the investment cost has gone up by 3, 4, 5%, but it's actually that we have all material on site in time to be able to commission the power plants as early as possible, and particularly given the current level of cash-on-cash returns. So just to give you an example, the 2 power plants we connected in Hungary at the end of last year, now in May, each of them in Tolna were about €1 million of investment, and in July each of those generated over €110,000, which you can find in our monthly report. So the cash-on-cash return is so significant. So a delay of 3 months is much more significant than if modules just cost you 5% more than what you had in your original plan. So it's about speed to market, speed to commissioning, and that's what we're focused on.
Mm-hmm. Good. Maybe about the next question is about new markets. If you're open to new markets, I think we answered already. What are the criteria when it comes to choosing new markets? George, maybe I can give a few insights there.
It's a good question. Well, I would say around the CE region, with Pav and I, we're looking at, once you're in Romania, Bulgaria is next door, clearly ex-Yugoslavia will probably develop as a destination. So we're looking at these markets. I think what is important for us is that we have a good idea how we can sell the electricity in an efficient way. Market prices across the region are very, very similar. I think it's whenever we enter a new market, we like to start small. So entering a new market requires a lot of setup efforts. So we need to understand, of course, how projects are developed, over regulation and so on. So it's a learning curve. It's a time investment. At the moment, at this point in time, in relation to the surroundings of the CE region, we are more focused on getting as much as we can out of the markets where we're already active. But looking further afield, we are a player that, so we're not afraid of distance, given that we're in Australia, but we cannot be everywhere. So what we're looking for is a market where we are not necessarily competing against the very big global players who have lower cost of capital, but where we feel comfortable with the stability of the market, of the country, of the regulatory framework. But I would also have to say that, of course, things have changed. So a year ago, when energy prices in Europe were 60, 80, and even €100, there were markets in the world where we could look at generating €150. They are probably still at 150 or €200, where in Europe we can generate 300, 400, €500 per megawatt hour. So the relative attractiveness has shifted in this last year. But on the other hand, of course, as our outlook is global, having a more diversified generation portfolio would also not be necessarily a bad thing. So while a year ago it was looking for markets where we can generate more higher revenues per megawatt installed capacity. I think now the element of providing diversification to our generation portfolio against the growing dominance of European assets is coming a bit more to the forefront. So we're constantly looking, and when we like a market, we start digging deeper. And if we feel comfortable, we will do stuff. Typically, we'll start with a relatively small first project, learn the lessons, and then scale up, as we've done in Australia and other markets.
Okay. The next question is about our equity ratio. That last year we increased the equity ratio by selling shares on from our own book. That is correct, which was our first actually placement of shares and capital raise, equity raise in the company history since its foundation. Do you think about selling more to increase the equity ratio? Well, and do you still have shares to sell? Well, first is yes, we still have treasury shares in the company. You can see in our report. At the moment, we have a very sound equity ratio of 26.7%. Our adjusted equity ratio, as we mentioned before, is on 29% even. So we feel very comfortable from that point of view, and we are not unnecessarily increasing that. In the longer run, as we said in our guidance, 25% is for us the minimum where we want to be with our equity ratio. We can see now in our forecasting, with the positive business development, we will generate organically equity from our business operations. We will increase that continuing. But we also, with the further investments, will also get additional debt financing into the company. So all this together will we make sure that our equity ratio stays above the 25%. So in the short run, this means we don't see at the moment a need for additional equity from outside. The last question: how many people do you employ, cooperate with? How many people we employ is easy to answer. We have a head count at the end of Q2 of 176, coming from 144 at the beginning of the year. That number is, as you can see, growing. How many people we cooperate with is a little more difficult to say. I think many more. Yes, what I think important to say is we clearly intend to grow as a company. That means we are also looking for more people. Nevertheless, we also can see that the growth of the business as such, or the economies of scale are kicking in. So the business is growing more than the organization behind in terms of number of people we need to deliver that additional business. Good. I think this was all about the questions we have at the moment. We are
Someone is typing, so maybe there's one.
Okay.
Okay, good question.
Okay, there's
biggest risk for
the biggest risk for the company in the next 12 months. George, there's a lot of risks generally that our business and the economy is exposed to.
Well, I guess it is definitely inflation in relation to that, interest rates. Yeah, so we did not touch
new business development.
Yeah, we did not touch upon this today, but maybe it's worth mentioning. So when we build power plants in Hungary, Romania, and have a merchant approach, electricity is traded in euros. So while we get forints and their own physically for selling electricity, the underlying price is in euros. So these are quasi-euro revenues, and on the back of that, the banks that provide us with the funding, the project funding, are willing to finance in euros because basically each month there's a few weeks of interest rate, sorry, of exchange rate exposure, but over the long term that is basically immaterial. So so it means that at the moment, well, a significant interest differential has opened between the Czech koruna or the zloty, the foreign and RON to the euro. We are actually benefiting still from the euro interest rates, which are significantly lower. But I think if inflation persists and interest rates go up really significantly, that may have an impact. I think the other big one is of course certain regulatory measures or tax measures, and there are various types of windfall taxation. In some cases it has been implemented, in some countries it's being discussed, where I think that these discussions are sometimes very weird to listen to. I think one of the things, I mean, on one hand, in today's situation, politicians and regulators want more renewables. Yes, companies like us or investors like us who have not and are not dependent on support schemes, who have not entered into PPAs, are now therefore benefiting for these higher prices. Yes, there is a we are making more money than we planned. However, of course, now coming and hitting us with the tax hammer is not going to be helpful in encouraging more investment. And actually, I come back to Hungary, because this is where, as Clemens mentioned, we have been exposed to this at this point in time to a certain limited extent. We are also aware that with our merchant approach, given current rules, we are not subject to this tax for merchant projects. However, what we have seen in the market is that a lot of investors are holding back with projects. So a lot of projects that would be ready to build and where investors have lined up, they are now trying to sit out this and next year when this tax applies. And I mean, what the Hungarians have done, it's very surprising, because the last 5 years we've been active, we were actually very, it was a very well functioning market in terms of when they changed regulation. It was very understandable why they did certain things. This time around, I don't understand it, because they introduced this. Such tax measures always, of course, lead to shatter confidence. They've hit a relatively small section of projects or of operating power plants. So for very little gain, they've caused a lot of damage and now slowed down the development or the rollout of additional solar power plants. On top of that, now they've also made it more complicated by requiring storage, where they themselves, the regulators, don't know actually what they want. So these would be very, very counterproductive moves, which doesn't mean that it will not be tried. I think directing it at renewable generators is very counterproductive. It's also important to bear in mind that wind and solar in particular are actually driving down prices when generation is peaking. So you can see that midday in the afternoon, and it's most visible on weekends, we are actually driving down prices. So we are helping this. So clearly the increase is not driven by us. We're actually helping. The more gets built, the stronger the mitigating factor on energy prices from renewables. But of course, we live in unprecedented times. So yes, that is a risk. However, and when you just take the tax structure in Hungary, 65% of the excess. So we're still, the 35% still means that we are making more than double of what we'll be getting on the feed-in tariff. And we are well above our LCOE. So it's definitely not anything that would put our company at existential risk. So these are, I think, the two factors. Clearly,
main factors.
Well, the last one, I think,
the supply chain.
The supply chain. I mean, if the comrades in Beijing decide to bring Taiwan home, as they call it, we may see some disruptions. So that's the third one I would see. Clearly, there's lots more, but
the pandemic as well. If this come back and they shut down their harbors again for certain times, that might disrupt temporarily the supply chain. But on the other side, I think we have been, as you also could see from increasing inventories, and we so far have worked very well around that our deliveries throughout this first half year, end of the day came here. So, but you never know.
yes.
Good. We're a little over time. Thank you very much for staying so long with us and for your interest in our company, that you spent even more time than we have planned with us. I think if there's no more other questions, we can close the call here, and are looking forward to present to you our Q3 numbers in about pretty much 3 months from now. Yeah, we are happy to hear again. And if there should be any other questions that you might have that we could not answer or that come up later, please direct them directly to our IR, investor relation @photonenergy.com. Thank you very much.
Thank you very much. Have a nice day. Bye-bye.
Bye.